Welcome to our revision class in corporate finance. In this class, we're going to look at units 1 to 3. In units 1 to 3, we have 90% theory and 10% calculation, which is time value of money. So in the first units, which is an overview, we're going to understand what types of organizations are there. So I'll go through the types of organizations within maybe 10 minutes. We have different business structures that you need to know. And these business structures are what form a legal form under which businesses must operate. We have PACRA in Zambia that registers these business operations. And depending on what type of an investor you are, what kind of risk tolerance you have, the need for funding that you have, the desire for control and growth, you can be guided by any of these three structures. Can somebody tell me any four business structures that we know? Number one, if you've never participated, this is a session that you need to all participate. The key business structures that we have, number one, we have what? A sole proprietor or a sole trader. Number two, we have what? A partnership. Number three, we have a private company. Number four, a public company, okay, or corporation. So can somebody tell me who is a sole trader and what is involved in sole proprietorship? Quickly. Melissa? A sole
So
trader?
this is an entity that is run by a single individual.
Uh-huh. So this entity is run by a single individual. It's one of the simplest forms of businesses. Very common. Owned by one person, no legal distinction between the owner and the business, right? The person enjoys all the profits and bears all the risks, and there are very minimal capital requirements. What are the disadvantages of a sole trader?
The business lacks continuity,
Uh-huh.
limited access to capital as it's only funded by one person.
Great.
And no
Okay.
separately governed entity.
So what advantages are there in this type of business? It's easy to set up. You have full control. There's no need to consult anyone. You maintain and retain all the profits. Okay, you don't share with anyone. And it's flexible. You can change the direction, can close the shop. There's limited bureaucracy. What are the disadvantages of this kind of business? You have unlimited liability, meaning when the owner dies, the business dies also. All right. In terms of funding, you are limited. You are restricted to your personal savings or loans. And there's limited skill because you are one person based on your knowledge. There's lack of continuity, meaning business may end if the person dies. All right. So remember, my concern is understanding our question which carries 12 marks. I really feel bad when people lose marks because of failing to understand. So we're looking at Mr. Greg has obtained a patent on a new device that lowers insects and electrocutes them once they touch the grid inside the device. He is at the stage of manufacturing the first units and marketing the device and has asked you to advise him on whether he should operate as a sole trader within a partnership, a private or public company. How would you advise change as the entity grows over time? So this is 12 marks. So these 12 marks should be based on the knowledge that we're going to have now, okay? So firstly, we are trying to express our understanding on the business structures that are there. Then we advise this guy based on which business he must operate. So I need your participation. So we're just discussing the market, the available business structures that we have. So we're just from talking about who a sole trader is and what advantages and disadvantages are. Okay, then the ladies now take it up what a partnership is, and the gents take it up what company is. Just give me as much detail as you can. Then we'll look at questions that will come surrounding that. So ladies, partnership.
So a partnership is an entity that is run by two individuals. One of the major advantages of a partnership are that, unlike a sole trader, there's more skill available. It's the fact that there are two people, capital as well. They are the fact that there's also more than one individual. They're able to generate capital better than a sole trader. Disadvantage being that they have limited liability. In an event, one partner dies or is no longer is deceased, it means that now you have to go back to recreate this partnership.
Excellent. So there are two types of partnerships. There could be general or limited. Who are general partners? Where everyone is liable. And limited partners are partnerships where we have a few partners who are limited by liability based on what they have invested. And partnership has what is called a partnership deed. It needn't be written, it can be oral or written. And the advantages are that there's shared responsibility and you have more capital and more expertise. Disadvantages is that the death or entry of the partner will result to the demise of the partnership, and it's prone to conflict and you have to share your profits and also risk of what? Um, Intellectual property. So sharing ownership will weaken control over the patents that you have. So why uh, can a partnership be recommended to Mr. Craig, and why shouldn't it be considered? We'll look at that later on. Then the gents, tell us about the private company. What are the characteristics, advantages and disadvantages quickly within 2 minutes? No, Mr. Malambo. I love interactive classes because from these we get to brainstorm. Okay, ladies, you can help out. Private company.
A private company is a company that is also listed, but they do not advertise their shares at the stock exchange. They do not also make their financials public, so they are more private. So if you want to buy shares, it has to be through people that you know or the people that are already in the company who tell you to say, we have these shares, then you can buy from there. So capital is also easy to raise because you can have as many people as you want. Yeah, and there's continuity even after the death of one partner. Yes.
Exactly. So it's a separate legal entity where the shareholders are separate from the ownership of the company. There's legal entity, there's limited liability. The company is owned by owners who are called the shareholders. These shareholders can be preferential or ordinary shareholders. It is managed by directors, and you cannot sell the shares on the listed market. You can share it with friends and family. So, based on those characteristics, you can also talk about the advantages and disadvantages of this kind of business. The advantages could be number one, the aspect of limited liability, meaning you lose only up to your investment. Personal property is protected, and you have separate legal entity, meaning the company can sue, be sued, enter contracts, and also own assets. And easy to raise finance through sale of shares on the stock market, and it's more attractive to investors and banks. So there's continuity, meaning the business will continue even if an individual dies. And credibility, it's more trusted. And tax benefits, that corporate tax may be lower than the personal tax rates. The disadvantages is complex to set up There are high costs. We have auditing, compliance. There's less privacy because you may need to disclose, and regulatory requirements. You need to comply by the law. So we go to the public limited company. What is a public limited company and what are the characteristics, advantages and disadvantages? So far, I'm happy with the contribution. Then we analyze whether and why Mr. Craig must go through any of those. Yes? What's the difference? What is a public limited company? Which one ends with PLC and LTD? So public limited company ends with LTD. So the public limited company, PLC, is a company that can offer its shares to the general public, usually through the stock exchange. So shares are freely transferable. You can raise capital from the public. There are strict regulatory requirements, and it's managed by the board of directors. So what are the advantages and disadvantages? Advantages that there's access to a large pool of capital. You have expansion opportunities. There's prestige and reputation in such companies. And you have what? Liquidity of shares. You can buy and sell on the public easily. Disadvantage is that high cost is expensive to establish, and there's lots of control. As you bring in more and more people to buy shares, you dilute your ownership. And there's strict regulation where you need to publish your accounts to the general public under government scrutiny. And there's pressure for performance, so shareholders expect profits. All right. So now let's go to our question. Our question now goes back to us. So we are told that Mr. Greg has obtained a patent on a new device that allows insects, electrocutes them, and once they touch the grid inside the device, at this stage of manufacturing the first circuits and marketing the device, and has asked you to advise whether he should operate as a sole trader or partnership or company or public company. What's your take and advice? So there's no wrong answer based on how you justify the question.
So you can actually, I'm asking, you can actually explain all the three companies, or you can maybe tell the person, is it possible? Is it what they were asking to say? Maybe you can tell them to say, if you decide to become a private limited company, these are the advantages and the disadvantages, or you can choose to be this. So is it possible for you to actually advise him to choose between the companies by explaining the three companies, or they just wanted us to choose one company and
No, not necessarily.
explain?
You're now asking me to give you the solution. They were asking you to explain at what stage the company must exist under which conditions. So it can assume all the progressive types of companies depending on the stage. In this initial stage, we are seeing Mr. Greg producing its first unit. So it could be okay or suitable that he operates as what? A sole trader. Okay? Why? You now enlist the advantages because it's simple to establish. There are minimal requirements that are there, and it allow him to retain full control. Remember, he's patenting this untested what device that allures insects. Also explain the disadvantage that he may expect as being what? A sole trader in the initial stage. He'll be responsible for his data, his personal properties at risk. Are we together? So already you've answered partly the initial
Just a
stage.
question.
Are we
That's the
together?
question.
Uh-huh.
I've got a question.
Yes, please.
So now, because the question says you advise him on which we mention all these business structures. Then is it since you said so
Mhm.
is the one that you picked to say that was the right one? So if, for instance, I picked a private or I picked a partnership, and then I justify it to say the
Mhm.
reason why I'm advising Mr. whoever his name is, then I give him the advantages of that partnership. Are these two, is it wrong? Like if I had picked any,
So of
I'll
each of these
mention all
ones,
of them. I'll
sorry
mention
to
all
cut
of
you
them,
short.
then I pick one.
You get your marks, maybe 4 under each. But for this model, he repeats questions. I'm advising you to be objective in how we are answering. Remember, the contents of the question are very leading. They're telling you that he started with what? His units, a few first units, okay? You're looking at a company having a going concern. So a company is not static at this moment. You may want to suggest that as it grows, this is what will happen. So in the initial stages, we're looking at the advantages of what? So remember, there's just 12 marks. So think objectively. You could want to exhaust all your marks on a sole trader. Depending on the lenience of the lecturer, you may end up with 5 marks or 6 marks or so on how you justify. But it's not giving you to choose a particular question, a particular structure, right? It's helping you appreciate at what stage an organization must evolve. So there's an introductory stage where firms are just growing. Don't, then we go to now maybe the firm will expand. The advantages are progressive. We know partnership is progressive on sole trader. Private company is progressive on partnership. So as businesses, is everyone understanding what I'm trying to say? So the company now will want to assume legal entity, wants to use its assets and patent that product, wants to enter into contracts. And so remember, indirectly, it's mentioning the advantages and characteristics of what? Private company. So to protect Mr. Craig, this might limit his liability to what he has. So you can additionally advise him to go into private when he grows because it will be easy for him to raise capital so that they may be able to produce more of such units. And also there's a tax advantage that is there. So it also evolve in growing, but there are disadvantages. The setup cost will be high, and this is what will move in. You could also move in to argue out why other forms of a business will not be appropriate. So the growth stage will be what? A private limited company, where the company will increase, assume a private entity will take a limited liability to protect his personal assets from liability and risk. And additionally, the company will enter into advantages of raising more capital, improving credibility and continuity. These are the advantages we're talking about. All right. So maybe you get your additional 3 marks there. All right. So maybe the first part, depending on the marking key. So you have 3 marks, the first 3 marks. Then also you explain what? The other structures, because I've mentioned each of these ones. So you can also evolve. So we've talked about that. How about a partnership? Would you advise a partnership, knowing that disadvantages that are there? Maybe you say on that one, I may not recommend a partnership because of what? This reason. Why? You state what a partnership is all about and what is involved. So let me just talk about based on the marking key that I have in the pamphlet. Of course, it's subjective, so the points are validated by how you qualify them. So a partnership could not be advisable in this situation because you share control and decision making, and this would limit the authority that Mr. Craig may have over the patent. Furthermore, another one would say no, partnership will bring in a pool of resources, That would still be a correct answer because you're dominating on the advantages. But I wanted to contrast on what is essential to make this discourse more interesting. All right. Then you also go to the public limited company. Why would I advise Mr. Greg to go for that one? You also explain what is involved in the private and the large scale company, which is the public limited company. What did we say about public limited company? The requirement of what? Disclosure of accounts. There's huge capital requirement. There are a lot of possible losses of control. Therefore, you may suggest this to Mr. Craig as a major advantage when he is considering expansion. In a nutshell, you make a conclusion. So in conclusion, the most appropriate for Mr. Craig could be what? A sole trader, a private limited, if necessary, to go into a public company. Why? To maintain simplicity and control, credibility, and large-scale growth. Are we together? So this is how we're exhausting our 12 marks. Any questions, additions, subtractions? So today, I basically want to dominate on the fact that this course, you can mess it up on how you select your questions. I always advise students to appreciate the fact that you need to understand the principles in this course. Usually, the theoretical part is very important, where people get to understand the principles of corporate finance. The calculation part, I think we dominated in the tests, but I'll still look at them. So my introductory class is basically going to look at the papers that are looking at the theory aspects, especially from Unit 1 up until Unit 2. Any questions so far before I proceed?
Hi, evening. Could you just kindly repeat the last part where you said therefore, like as if you're concluding?
Okay. So what was our conclusion in our discourse? What would you advise Mr. Craig to go for? So there's no clear-cut conclusion we gave. We just subtracted one. We said, in conclusion, the most appropriate structure that he would go for would be from sole trader and expand to a private company. If necessary, go to a public company. So why is this approach appropriate to him? If he wants to maintain simplicity and control at the start, then also gain what? Protection and credibility, who go to the private company, then access large-scale financing, you go to public. So all these are progressive approaches that we would advise Mr. Craig to adopt. Is that clear?
Yes, it is. Thank you.
All right, any other questions? You can share your past papers by revising. See, that. So I'm looking at the pamphlet questions. Mm. Are we okay with the first part? Okay, so we're going to Unit 3 on sources of finance. Okay, so sources of finance, this question on FinoZ has always been there. So I want us to look at that question and see what the question the examiner is trying to ask. Can somebody read that question?
Which one?
Can I
Just
go ahead?
3.3?
3.3, yes.
Okay. Finos Solutions is planning to raise fresh equity capital and is choosing between an underwritten cash offer and a rights offering to current shareholders. The goal is to maximize the current shareholder wealth. What is your recommendation and why?
Okay. So what topic are we looking at? So
Sources of funds, is it?
sources of finance, yeah. So what are the main sources of finance that a firm may have or an organization?
We've got internal and external. Under internal, one of the main ones is where maybe shareholders can contribute more money to the business, or their equity, instead of their returns, instead of getting their returns, they put it back into their business. Then one of the external ways, they can either do it through a bank loan, they obtain a loan from the bank, or maybe bank overdraft, where maybe their account allows them to withdraw more than what's in the account.
Excellent. So the organizations have different sources of financing themselves to start to operate or to expand their projects. So it can be in small or big ways. They can buy assets, they can pay employees, they can also use this money to fund their daily funds. So there are two main categories there, what we call the internal and also the external sources of finance. Internal, we mean sources from within the business. External, we're looking at sources from outside the business. Okay? So these sources are very critical to understand, especially with regards to the objectives of an organization. So a question may come maybe based on your organization or your school. What sources can come from a school like UNILAS? Maybe looking at sources like school fees. So internal sources, we can look at examples like retained earnings, owner's equity, sale of assets, working capital. So each of these ones have their advantages and disadvantages. So when you're dealing with retained earnings, we're looking at plowed back profit. So this is a profit that is kept in the business instead of being distributed to the owners. You instead want to what? To use it. And this is another academic question we are going to look at later on, the principal agency problem. Okay. But there are advantages that are there with having to use information, having to use retained earnings because you have no interest to pay. It will also increase your business independence. You have readily available funds that have no interest, except that the disadvantages are that you reduce the dividends that the owners may have and the conflict may come in. Another source of finance I've talked about is what? Owner's equity. Can somebody give me the advantages and disadvantages of owner's capital?
Yeah, you don't need to pay back. So it doesn't encourage liability in business because you don't need to pay back the equity. And yeah, basically that's an advantage.
Okay, yes, you don't need to repay it. You have full control. The disadvantages for retained um retained capital or equity. What are the disadvantages? So I'm trying not to just limit myself to this question. Also, let's understand the key questions in which they could vary. What are the disadvantages of equity, retained owner's equity?
The risk is personal. In case the business fails, the risk will be just for the business.
Exactly. So we have what we call personal financial risk, and also you have limited finance available. Okay. Then we also have another internal source of finance, which is what? Sale of assets. So it's quick and minimizes maintenance costs. The advantage is that it's a one-time source of finance. Working capital, these are funds released by working capital. You have advantages of no external borrowing. It improves efficiency. Its advantages is that it may strain supply relationships. What are some of the external sources of finance that we may have in an institution? External sources of finance may include what?
Bank
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 overdraft.
loans, yes. Overdrafts. What are the advantages of
Leasing.
the bank loans? These are huge sums that are available and they are flexible payment periods. The disadvantages are interest costs that are there and you require collateral, and there are strict conditions for approval. External, we also mentioned overdraft. So what are the advantages and disadvantages? Yes,
If it's taken for a long time, it may be the disadvantage, it may be costly. And then there's also, you also pay interest for that. And then
yes,
the advantage is it helps with the cash flow. So meaning the money coming, it's easy for money to like come in and go out of the business.
yes. Very useful for short-term needs, flexible to access. About share capital, this is money raised by selling what? Shares to outsiders or other companies. What are the advantages? You don't need to repay it. They come in large bulk and reduces financial risks. The disadvantages are that you lose control and they expect dividends. Venture capital, where funds are provided by investors, okay, in exchange for ownership. So you have advantages of access to expertise and it's suitable for startups with high potential. The disadvantages, you lose control and this will expect their returns. We have trade credit, leasing, these are other sources of external funding. All right. Now, let's go to our question here. We have two options of funding that we have. FinoZ. Okay. Solutions is planning to raise what? Fresh capital, choosing between underwritten cash offer and rights offering the current shareholders. So to maximize the current shareholders' wealth, what is the recommendation and why? So there are two options that are there here. Okay, so FinoZ is a company that wants to raise equity. It has to choose between two. We have what is called the what? The underwritten cash offer and the rights offer to the current shareholders. And the goal of this company is to maximize the current shareholders' wealth. What is the recommendation? So, firstly, we've heard that the aim is to maximize the current shareholders' wealth. Okay, so let's understand what's the rights offer first of all. We look at option 1 and option 2. What is involved in the rights offer and what is involved in the underwriting? We discussed this question. So what
Let
is
me just
involved?
give it a try. Let's offer. This is the exclusive right or privilege that shareholders have to be the first one to be offered shares before they can be offered to a person outside the organization.
Okay. You're explaining the rights offer first, right? Okay. Yes. It is a And what is the underwritten offer? So for you to appreciate which one to go for, first you need to understand what each of them is all about. Then we advise which of the two the firm may go for. Are we together? So we must understand the two offers and what they entail, and we also pick the best. So rightly put, there's what we call the underwritten offer. It's also called the seasoned equity offer. It happens when a company issues new shares to the general public. So there we have an underwriter, usually an investment bank. It guarantees that the company will raise the required amount of money. So if the public does not buy the shares, the underwriter will buy the remaining shares and the company will still receive their full proceeds. So here's how it works. So the company now decides to raise the new equity capital. So the shares are offered to the public investors. The price is set before it is issued. An underwriter will guarantee the issuance. So if the shares are not fully subscribed, the underwriter will absorb unsold portion. So here the key feature is that the shares are sold to new external investors, and the existing shareholders are not given priority. So the underwriter will guarantee raising funds that are needed, and the fixed price is set in advance. Now, what is the implication of this? Is that this method will lead to what we call ownership dilution for the existing owners because we have new people on board to whom the shares are sold. So here the idea is that the company will sell shares to the public and the bank will guarantee that the company gets the money. Then we also have the rights issue. It's a method where a company will issue these new shares to the existing shareholders only and will give them the right, not the obligation, the right to buy additional shares in proportion to their current holdings, usually at a discounted price. So the process is as follows. So the company will announce this rights issue, and these existing shareholders will receive the rights certificate, and the shareholders can choose to buy these new shares. We call that exercise rights, or will sell these rights to the market. Now, these shares are offered at a what discount, but ultimately capital is raised to the company by the existing owners. So the features of this is that only the existing shareholders will participate, and the shares are offered in proportion. So one new share for every 5 maybe that you've held. So if you have 30, you may be entitled to 6. And the rights issue is traded in the market and it helps to maintain ownership. The implication here is that the shareholders will do what? They'll take up their rights. There's no dilution of ownership. The same people will be within unless maybe you decide to sell them. So the key difference is that number one, underwritten or cash offer, the general public can come in here. Rights offer, we're dealing with what? The indigenous. Then the ownership effect here dilutes the ownership. Then the other one will do what? Rights issue will maintain ownership. Pricing for the underwritten, you have a fixed price here. It's usually at a discounted. Then control, it shifts to outsiders. And for rights, it's within. And the risk, the underwriter guarantees the funds. And here the risk is that what? Shareholders decide participation. All right. Now, with that being said, which offer would you suggest be considered? Let's go to our question now. We are given what?
Right.
Innocent is
Offer.
planning to raise fresh or choosing between underwritten offer and rights offering to the current shareholders. The goal is to maximize shareholders' wealth. What is your recommendation and why?
Rights offer.
The rights offer why?
Why? I would say because it's the cost is lower.
Mm-hmm.
The risk of not raising funds. I would say the
Yes,
cost
that's
is
one
low.
key Yeah.
Then
Okay, can I add to that?
the existing ownership is it's kept in control by the shareholders.
Okay, good. Remember how many marks are we looking at? We're looking at about 12 marks. So you need to give the reason and explain very well.
Can I
And
add to
then the
that?
other thing is, since it's about wealth maximization of shareholders, so when the shareholders put in more money and it comes to like the existing shareholders, so it will mean whatever profit they'll get more dividend as compared to bringing in more shareholders where now they have to share the profit amongst a lot of them. And also the power that they'll have won't be diluted.
Okay, good. Yes. Others?
Yeah, because the shares are discounted, then it gives the shareholders an opportunity to buy the shares at a reduced price, meaning they'll have more shares. So meaning it's still going to benefit them.
Yes, so we're looking at 13 marks. So please give the reason. Number one, it protects. We have all agreed that the rights is the best, right? Yes. So number one, it protects the shareholders' wealth. Why? The existing shareholders will either maintain ownership or buy new shares. Number two, there is no ownership that is diluted. So here, shareholders will keep their proportion and they still control. Number three, it avoids what? Wealth transfer to outsiders. So the benefit will be from the discounted pricing, the existing shareholders will benefit. Also, the lower issuance costs. Remember, using the other method, there are costs that you need to pay. The rights issue generally, they are lower underwriting costs or administrative costs compared to public cash offers. Then also, it is a positive, there's positive market signal. So it signals that management believes the shares are fairly valued and reducing uh, will reduce the risk of price reaction. Then also, fair treatment to the shareholders. It gives the existing shareholders what equal opportunity to participate based on their current holdings. And also, there's aspect of flexibility with standby underwriting. So even if some shareholders cannot participate, a standby underwriter will ensure that capital is still raised without what losing benefits. So you need to explain those key points. Okay. Are we together?
Yes, we are.
The rights issue has been preferred. Why? It will protect the existing shareholders' wealth because the current what shareholders are given first priority. It avoids dilution of ownership. It prevents what wealth transfer to outside world since only existing are given priority. It also is at a lower issuance cost compared to the underwritten offer because it what doesn't rely on expensive underwriting assignments or agreements. So that is how we can answer that. All right. Are we appreciating this? Then I discussed the dividend policy in the previous class, although this is unit 13, but it's part of the theoretical questions. I don't know whether we should look at it at this point or when I will be looking at the last unit. My concentration is on units 1 to 3. Any questions before I proceed?
I have a question. It's on sources of finance.
Mm-hmm.
Yeah, so it's outside when like on the Islamic finance, huh? So
Mm-hmm.
what would you advise? Let's say a question comes on the Islamic finance and you're talking about the instruments. do you think you can be awarded marks if you just explain them and you don't remember the ijara and sukuk, whatever it is, those things,
We'll
or you
discuss that.
have to memorize them?
At least you know one or two. We discussed that in the previous class. Yeah. So let's look at this in our next few minutes on sources of finance. Okay. Then we can call it an evening.
Is it okay to share the recording of the
Yes, I'll share the recording and
for the
better.
same Java, whatever it is?
Okay. So we have what we call the markets, money markets. Okay, I discussed money markets with you. Okay, what topic is this? The money markets and capital markets. What is in the capital markets? What are money markets? What's the capital market? And what are some of the determinants that are involved in each of these ones? And what is capital structure? So here we have key elements of capital structure. We have aspects of the debt instruments that are used. So before I go into understanding this question, let me just take you through a few key important points that you need to know on the capital structure. So firms have what we call a capital structure. What is a capital structure? Capital structure basically looks at the mix of how much a firm must use to finance itself. Okay, a mix of this and that. So we're going to look at these two, then explain how they're used. So the meaning of capital structure basically looks at a way that a firm finances what? Its operations, its growth, using different sources of funds. So we have two main, there's what we call debt finance and equity finance. And what is debt finance, Penelope? These are monies borrowed from the bank, overdrafts, bonds, okay, and other credit facilities. What is equity finance? This is owners' funds that comes in terms of ordinary shares, preference shares, and retained earnings. So in practice, most firms combine here a little, there a little. So this we call what? The capital structure, depending on the risk tolerance and profitability and strategy goals. So one of the main objective of the capital structure is to optimize this capital mix. So it may depend on what type of business you are in. Sometimes debt is the best than using what? Equity to avoid diluting your ownership. So the main objective of capital structure is to identify the optimal capital mix, the combination, which ultimately gives us a minimal WACC, cost of capital. All right. So the essence of having an optimal capital mix, which is the combination of debt and equity, is to number one, achieve the minimal overall cost of capital, meaning debt is even cheaper sometimes than equity due to the tax shield. Also, reducing the financial risk, meaning financial risk is the risk of default. Okay. Having an optimal capital mix is also important because it also helps to maximize shareholders' wealth. Okay, so a good structure will balance return and risk. So, what are some of the key determinants of capital structure? Number one, the key determinant of capital structure is as follows. Determinant of capital structure. What are some of the key determinants of capital structure? Anyone? I talked about this last time. What are the key determinants of capital structure? We're doing revisions. Number one, the business risk. So the business risk here, we're looking at the levels of uncertainty of the operating income. So firms with stable cash flows can comfortably use what debt. So this is what our question is going to ask us. So to determine what capital structure to use, if you're given a case study, you need to look at what? The cash flow stability. Firms that have volatile earnings, they face difficulty in meeting their fixed debt obligation. So if you have irregular earnings, so you need to see that your best possible source of capital mix should come from equity because they'll not require deadlines. Number two, the growth of the firm. So usually startups and high growth firms rely on what? Equity due to the uncertainty. Mature firms, they have stable earnings, they can take on more debt because they know they'll pay even overnight. The other determinant is profitability. So high profitable firms may prefer what? Retained earnings. Okay, in terms of equity financing. They prefer they are less profitable firms, so they rely more on what? If these firms are less profitable, they may rely more on external financing like debt or equity. The other aspect that will affect the choice will be your tax environment. So debt is attractive because there is what? The interest payment is tax deductible. So there's what is called a tax shield. Okay, 1 minus tax, it reduces your effective borrowing. Then also the access to financial markets. So large firms have easier access to loans, bonds, and equity markets. So that's another determinant on your capital structure source of funding. So small firms usually face borrowing constraints due to high interest rates. Then also your management risk appetite. So conservative managers will prefer lower debt. Aggressive managers will may increase leverage to boost their returns. So the principle here is that the higher the risk, the low debt usage. Low risk, you get high debt usage. So this is because debt usually introduces what is called a fixed financial obligation, which comes in terms of interest rates. These must be paid. So if cash is stable, meaning debt becomes manageable. If cash is unstable, you don't even go to debt. Better look at equity financing. So, by the way, my concentration is us looking at these two volatile firms. There are two firms that need to raise finance. There's Alusungo, which has volatile cash flows and high growth, and we have Banja, which has stable and mature industry. All things being equal, which of the firms should borrow and why? This is about 10 marks. All right? With what I've explained before I go to the next part. We are looking at what? The capital structure. We have two firms there. We have those two firms.
So I think from the things that you just talked about, Banja Corporation should be the one to borrow because it has a more stable inflow of cash and also a more mature industry, meaning that it has more access to financial markets meaning that if it were to borrow, there is a possibility that it might borrow higher than it initially planned. And also the stability in income and maybe like profitability makes it more susceptible to pay back the loan that it will get.
Excellent. This is what I want. So now you see how that is applicable. You first analyze based on what we've been discussing. You can compare and give the aspects of the factors that I've talked about. So you can create a table like this. Okay? We're looking at two, Banja and Alusinge. Let's look at their cash flow stability. This one is low, this one is high. Their risk, business risks, Alusinge has high according to our data, and Banja has low. Ability to service debt, this one is uncertain, but this one is reliable. Okay? Then financial distress risk for Alusinge is high, and for Banja is low. So which firm should borrow? Banja should borrow. Why? The reasons are as outlined. Number one, where are we getting those key points? First of all, those of you who are lost were given in the question. And the question in the preamble says there are two firms. Alusungo, it has what? Volatile cash flows, it is high growth. Banja Corporation, it is stable, a mature industry. All things held constant. Which firm should what? Should borrow. And now, given those parameters, okay, the others were assumed because of the information that has been given. Cash flow stability, we can tell from that information that Alusungo has what? Low cash flow stability, whereas Banja has what? High cash flow stability. Business risk. Can you hear me?
Yes, we can.
Okay.
Yes.
People are getting tired now, right?
Not that.
Okay. So those are our summary. So now we have chosen one firm. This is about 15 marks. Why should Banja borrow more? Number one, stable cash flow reduces what? Risk. So Banja has predictable earnings. So they are sure that they can comfortably meet their interest obligations. They can pay even overnight during recessions. Number two, there is a lower probability of financial distress. Why? Because their income is stable. Some of these things are transient. So the risk of bankruptcy or default is very minimal with Banja. Then ability to meet what? To benefit from the tax shield. Remember, the tax shield is on the assumption by accountant that in the income statement, there's that corporation tax that is there. So according to financial accounting standards, there's a tax shield that is removed. I explained this when I was dealing with what? Cost of capital. So they will benefit from the debt tax deductible. So Banja can reduce on the what? Taxable income. Then also, in terms of stage of business, um, since Banja is in a mature industry, so growth opportunities there are what? Are limited. So they can efficiently use what? Debt instead of relying on reinvestment. So sometimes the people think Congole is always a bad idea. Congole sometimes is a good idea depending on where you are you are looking. All right. So this is why Banja should borrow more. Isn't this interesting? So you cannot guess when you don't know. So it comes from a certain background. All right. Are we together? So the reasons why Banja should borrow more is based on the profile of the two firms that has been given. Any questions at this point? Please speak now or forever hold your peace.
I have a question.
Uh-huh.
One of the key determinants of capital structure was growth stage of a firm.
Mm-hmm.
How do you explain that if it's like one of the things that has been given? Like, how do you contextualize it?
Okay, that question goes to all of us. I explained. Very good question.
What was the question again?
We talked about the factors that determine what? The choice of the mix, and a growth stage was one of them. So how do we contextualize to get more marks? How do we add or apply it in here? There's an aspect of the growth stage. So growth stage means that we are identifying where the firm is in this life cycle. Is it a startup? Is it high growth? Is it expansion stage? Is it maturity stage? And it matters because the growth stage will affect what? The cash flow stability. It will affect the reinvestment needs, the access to finance. It will affect what? The risk tolerance. So if we're going to apply this to these two firms, Alusinga, what were we told in this question about Alusinga and Banja in terms of their growth stage? It was mentioned. We're told that what? We're told that Alusinga is in high growth stage, meaning it's in rapid expansion or growth stage. What does that mean? It is still building, expanding in its market. It needs heavy reinvestment. It needs equipment. It needs project. It needs cash flows. Now, cash flows here are not yet stable. They're not predictable. And their profits are often what? Reinvested rather than they're distributed, remember. So linking this to the capital structure, this firm may need financial flexibility, and it cannot safely commit high obligations to paying fixed debt instruments. So it's better that this company goes to retained earnings and equity. So the growth stage here still reinforces the argument that Alusinga should borrow less. But look at Banja. Banja is in a mature stage. What happens is in a stable industry. What does it mean? In the context of growth, the growth opportunities are limited. They are predictable. Namafikapo. And what about their cash flows? They are stable. They are consistent. The firm generates absolutely steady profits, and it may not need heavy reinvestment. So, in terms of capital structure, at maturity stage, what will happen to this company? The firm already has excess stable cash flow, and it can comfortably meet their debt obligations, even if they are to borrow. So it can use that debt instead of stressing the owners of the business. Say, no, this money is let's reinvest. It will give the shareholders, we're giving you what belongs to Caesar, get your money. We'll borrow and we'll still pay them back. So it still supports that Banja should borrow more. Is that clear?
Yes, it is. Thank you.
Makes sense, huh? All right. So we end here for tonight.